Hi, everybody. Thanks for joining us. We're going to give it just a minute or two more. We have people that are still attending. But as you can see, we are now on, I think it's our third webinar in the Wealth Summit Bonus Advanced webinars that David is going to be doing. And today he's going to be discussing advanced plans, including profit sharing and specialized 401ks. At the end of the webinar, we'd be happy to answer any questions. You can also type in your questions during the webinar and they'll go into a queue and we can address them at the end of the presentation. So it looks like we have a number of people signing on, and I think that we're probably going to start here just a few moments with David, and he's going to take it away. Okay, David, are you there? Are you ready to start?
I'm ready.
Okay, great.
Okay, good. Welcome again, everybody. As Jen said, this is the third installment of our pension plan. We're going to be talking about some advanced plan design today. So as you recall, we started session one with an overview of pension plans, how they work, the basics, why you would want to offer one, the benefits to you as an employer, the benefits to you as an employee, as well as the other employees in your firm. We built on that. Session two, we covered the two most common types of 401ks that we use. Oh, in session one, we also touched on the SEP and Simple, which are legitimate options, but the 401k is a much better option. So section two was devoted to the safe harbor and solo 401k, which are the most typical plan designs that we see. And so today we're building on that, and we're going to talk about something called a money purchase pension plan, as well as advanced 401ks. So as you recall, I have this little chart here that lays out all the different types of business retirement plans. As I mentioned here on the right, the IRA-based plans, we touched base with that on quickly on the first session. The second session, we focused on the 401k. Now we're going to add in, you see on the left-hand side, money purchase pension, which is a fixed contribution subset of a defined contribution plan. I know it's confusing, but that will make ultimate sense here in just a minute. Okay, so money purchase pension plan. This is something that you may not have heard a lot about because they're not used very much, number one. And number two, frankly, there are much better options. The reason I bring this up, it is an option, number one, and there are companies that use it. In fact, many of you know I'm head of the investment committee and on the board of a big health system called Carolina East Health Systems. And we actually have a money purchase pension plan that I run for the couple thousand employees that work there. And so it still does have a place, mostly for your larger, more stable businesses. As you can see here, it can be a standalone plan, or you can pair it with a 401k. The big thing right there is the third bullet point. It has required annual contributions. I'll come back to that in a minute. Any size business can do it, and it is subject to non-discrimination testing. The contribution, you can select any amount. It's a percentage of pay, 1%, 2%. At Carolina East, for many, many years, we did a 10% contribution to pay. So if you think of a money purchase pension plan, it's like a profit sharing plan, except that you're required to contribute a certain amount each year to the plan, and it's not discretionary. You can't decide at the end of the year, oh gosh, we didn't have a very good year and we're not going to put anything in. It is mandatory. Each employee does have a separate account, meaning that it's not a big pool of money. Each person gets their dollar amount allocated to them, and they choose from an investment menu. The limit for contributions is 25% of compensation, which in 2019 is either $56,000, or if they're over the age of 50, $64,000. So it's a pretty simple plan, a percentage of the employee's salary. Investments, like I said, it's just like a 401k. You come up with a menu of options, and then the employee is responsible for choosing those options, and the benefit that they ultimately receive is based solely on the gains and losses in the account. Some pros and cons. Number one pro, higher contribution amounts possible than some other plans. A pro from the employee standpoint is employer-only contributions. And the employees receive a guaranteed amount. I mean, that's the biggest thing. When you're dealing at a little bit bigger company and the employees are maybe a little less sophisticated to some extent and are really focused on a guaranteed pension plan, but you don't want to get into a defined benefit, that's really where this is a pro. Typically, on the con side, it's going to have a higher administrative cost. From the employer's perspective, a con is that they employer-only contributions. If you don't meet those contributions, there's some excise taxes, and it really becomes a big mess. And then, of course, having to make those mandatory contributions, and the plan has to pass discrimination testing as well. I have a little note down there. There are employee contributions allowed in certain circumstances, although I've never actually seen a money purchase pension where it was. But just in case you're reading something and you see, hey, employee contributions are allowed, just know that that is the very, very rare case indeed. Okay, so let's move on to a profit sharing plan. So a profit sharing plan can be a standalone plan, or more commonly, it's paired with a 401k. But we have had companies that we've worked with that came in and they had no 401k, they just had a profit sharing plan. But one thing about it, big difference between the money purchase pension, they're discretionary contributions from year to year. The other question I get a lot of times is, it doesn't have to be out of the profits of the company either. You don't even have to make a profit. I mean, there are instances where the company could have negative income for the year, but you still are able to make a profit sharing contribution. So the name is a little bit of a misnomer in that you don't actually have to have profits. The key here is the allocation of participants is according to a definitive formula. And here's where the really creative part comes into play. These are the 4 allocation methods that we're going to talk about today. The first couple are pretty simple, so we're really going to stay on this slide here and talk about them. Number 1 is the pro rata method. Essentially, it's proportional to the amount of salary that they make. You as a company say, okay, well, I want to give, you can do it one of 2 ways. You can say, okay, I want to give everybody 5% of their compensation as a bonus, or other times employers look at, okay, we have $100,000 to distribute among everybody, and so everybody gets an equal slice of that bonus. Pretty simple to understand. Every person receives a uniform percentage of their pay. Number 2 is what's called an integrated plan, also known as a permitted disparity plan. And what this does is it considers the pay and the Social Security level that somebody pays. So for example, right now, the Social Security wage base is $132,900. What that means is if you pay yourself more than that, or you have an employee that makes more than that amount, they do not accrue any additional Social Security benefits. And so in a sort of odd way, that penalizes them in retirement for making a lot of money. They're not accruing any Social Security benefits. And so what the integrated plan does is it takes into consideration that amount of pay above the Social Security wage base, and it allocates more money to those employees that make more than the wage base. So essentially with an integrated plan, those that make more than the wage base are going to get a higher percentage of the profit sharing plan allocated to them. The next one, the age weighted, is pretty self-explanatory. It weights the percentage allocated to each person based on the age of the participant. Once again, recognizing possibly that people that are later in life need to save more money for retirement than those that are younger. It takes into account the time value of money, and so you're able to give a higher percentage to those that are simply older. It doesn't it doesn't look at what they're paid, whether they're paid a lot, a little, whatever, it doesn't matter. It just takes into account their age and weights them more. The last one that we're going to talk about, what's called the new comparability, also known as a cross-tested plan, divides employees into groups based on business classifications like owners, non-owners, things like that. We'll get into the details in just a second, but it provides a great deal of flexibility in terms of how you can target your profit sharing plan to those that you want to benefit the most. Now, along with that flexibility is a lot more non-discrimination and testing that you have to pass, whereas the first three, pro rata, integrated, and age-weighted, are considered safe harbor, not in the sense the same safe harbor plan as a 401k. Remember, the profit sharing plan is a separate plan, but we use the term safe harbor, meaning that if you use one of these first three allocation methods, there's no additional testing required for that. Okay, so what is a new comparability or cross-tested plan? You have to set out the contribution by some sort of formula in the plan document, where you divide people into two or more groups, like job category, age, how long they've been with you, owners, non-owners, things like that. The way that this plan works out is really dependent on the demographics of your company and who you're trying to target. Believe it or not, under a new comparability plan, each individual employee can be his or her own group. And so you are able to target things, but sometimes, depending on the demographics, you may not be able to get the desired result. Most of the time we can, playing around with the different things that you're allowed to, but just keep in mind that it is dependent upon your demographics. The one I can think of, not likely, but if you're the owner and you're younger and make less money than everybody else in the company, it may be hard to skew the benefits to you as the owner. Okay, so the general concept of the new comparability profit sharing plan is it relies on the time value of money to maximize the benefits to certain people. So for example, if you're close to retirement, i.e. you're older than everybody else, you get more contribution. And by the way, you can pick a standard retirement date in your plan, but essentially people that are older are going to get more contribution. Also, people that are higher pay can get more contribution. The calculations are very involved, and you need some software that knows what you're doing to do this, and you factor in an assumed interest rate that the retirement contribution is going to earn, and you come up with an estimated benefit at that retirement age. You do need an actuary to verify the calculations and sign off, usually done by your TPA, third-party administrator for your plan. And the last bullet point, it's important to remember that it is discretionary. And so what we typically do is at the end of the year, once everybody's been paid and you know who was employed and who qualified for the plan, we'll sit down and we'll load up a census into the software, and we'll see what sort of profit sharing allocation we could come up with. And at that point, you can decide to do it, not do it at that point. So you don't have to decide at the beginning of the year how it's going to work out. And in fact, it's impossible, because you don't always know who's going to be in your company for the higher year, for the entire year. Okay, testing. Let's talk about testing. The concept of testing is that the IRS is the regulator of these plans under ERISA, is that it has to be non-discriminatory towards certain groups of people. Highly compensated people and owners of the company are who really they're looking at to make sure that there's not a disproportionate amount of benefits going to them. So for example, you can't set up a retirement plan and just have it cover the owners and not cover anybody else in the plan. That would be considered discriminatory. One other thing when I'm talking about discriminatory, for those of you, I know a lot of you are into the multiple business strategy, and you have different companies that are either related to your main company or even side companies that have a different business purpose and aren't really related, or even a spouse. You have to be careful when it comes to qualified plans. There are what's called consolidated groups of companies and affiliated service groups. And I don't want to get too sidetracked today into that, but suffice to say, if you or the same group of people own another company in certain proportions, then all the employees of that company must also be included in the retirement plan. And where it gets really confusing is when you have spouses that are part owners of a business with one spouse that maybe they don't actively participate in, but they also have another business. You really have to be careful, is you can inadvertently pull together for retirement plan purposes two businesses that have nothing to do with each other than a common owner of a spouse. Now, I say that in a sort of negative way. In some instances, pulling in another group of employees can actually be positive to help you pass some of the testing. But it's just something to consider if you have multiple businesses, to be very careful and make sure that you understand the rules behind that. It's designed to prevent you, let's say, here at BlueSky, it's to prevent me from going out and setting up a second company that has no employees except me, and then having BlueSky, pay like a service fee over to my own company. And then I have this, really fancy beneficial retirement plan in the company that I'm the only employee in, and everybody else left over in BlueSky gets nothing. So that's why they have the consolidated group and affiliated service group rules. Okay, so back to the testing slide here. The benefits must be non-discriminatory on a benefit basis. If you recall back on the other slides, the pro rata, it couldn't be discriminatory on a percentage basis. The beauty of cross-testing is that you're looking for equality of a proportional outcome. Meaning if you have somebody that's 20 and makes $25,000 a year, how can we make the equivalent result by the time they're 65 the same as somebody that's 60 and makes $250,000 a year? So you look at those equivalent benefits at the same time, and then using the time value of money, you convert that to a projected benefit, which then drives how much you have to put into the plan today. And the reason, where the term cross-tested comes from, some people call it a new comparability plan. Some people call it cross-tested. The cross-testing concept comes from, these are the same tests that a defined benefit plan has to meet. So remember, a 401k is a defined contribution plan. A profit sharing plan also falls under defined contribution plan, but a new comparability setup on a profit sharing is called cross-tested because it has to meet the tests of a defined benefit plan. Okay, that's a little bit technical, but I think it's important that people understand some of that. We're actually going to get into some of the other tests in a minute, but this non-discrimination testing is all that, making sure that there's an equal benefit applied to every employee. Okay, contribution groups. Groups can be segregated in many ways. You could have owners, non-owners. In our medical practices, you could have doctors, nurses, admin. You can break up your employee base as many ways as you want. Some really smart pension people many years ago figured out that under the law, you can actually set this up so that each employee is his or her own group. And so typically, we'll just set it up that way. Now you can, when each person is their own group, you can certainly group them into some of the higher structures if you want to when you're targeting who you're trying to benefit. But that gives you the most flexibility if you put each person in their own group. I mean, I've seen plans where we were able to design it such that, you know, really great benefits for the owner and most of the employees, and then one employee, typically a younger person, will give them a little bit additional benefit. Maybe everybody's getting 5, and we give this one person, you know, they're a young superstar, and we give them 10%, and it can make the whole plan pass testing. And so that's the benefit of putting each person in their own group, is you can actually single out those people based on their age or how much they make, and customize what they get to pass the testing. And that's the part of, you know, getting as creative as need be. Okay, a couple other tests. The profit sharing, you know, when you add a profit sharing in, of course, you still have the 401k testing that you have to meet. Now, if you're a safe harbor plan, and you make a profit sharing contribution, while some things are still considered safe harbor, it does subject your entire plan to testing. So keep that in mind. If you have a safe harbor 401k and you actually make a profit sharing test, while some components are still considered safe harbor, you do have to pass additional testing. And one of those is what's called the contribution gateway, we'll get into a minute, and the average benefits test. Now, while we're here on this slide, I want to mention, we'll talk about it again in a minute, but most people, when they set up a safe harbor 401k, they select the matching component, meaning, okay, if employee A defers some money into the 401k, we'll match it 50%, you know, on the first 4%, and then we'll 100% on the first 3%, and then 50% on the next 2%, up to 5% of salary, which essentially gives you a 4% match. That's the typical safe harbor match that people pick. There is another safe harbor provision that people can use. It's called a 3% non-elective. And what that means is you give 3% to everybody that qualifies for the plan, whether they defer any salary or not. And the reason I bring that up is, if you're not doing profit sharing, obviously just matching people that participate is a nice incentive to encourage people to participate. And by doing so, you automatically pass what's called the deferral, actual deferral percentage test, and the actual contribution percentage test. That's what the safe harbor means. It means, hey, if you give employees something, then you're exempt from the contribution percentage and deferral percentage testing. However, once you get into the profit sharing world and you start making profit sharing contributions, while the safe harbor match does satisfy a couple of those tests, it cannot be used for the gateway testing or the top heavy or average benefit testing. Suffice to say, it can't be used to satisfy testing for some things. So when you're looking at that safe harbor plan, selecting the 3% non-elective, where you give 3% to everybody, is usually going to allow you to do what you need to do at a much lower employer cost. So I know that's kind of difficult. When I go to the examples, I'll show you what I mean about that. But just keep that in mind. The way that you do matching on the safe harbor side impacts the design on the profit sharing side. Okay, so let's talk about the contribution gateway test. Once again, going back to our basic principles, that all employees need to receive some benefit. And the gateway contribution is what I call the price of admission. You know, if you want to get into the advanced plan design, you have to make some sort of contribution to all employees. And you can't favor too much the highly compensated employees, which for this year is anyone making more than $125,000 a year. So anyway, the gateway contribution is the lesser of 5% or 1/3 of the highest percentage allocated to any of those highly compensated employees. The last bullet point there, you'll see if you're doing the 3% non-elective safe harbor instead of the matching on the 401k side, that counts for the gateway. So at the most, you would have to add an extra 2% to everyone's profit sharing contribution. So using that 3% non-elective allows you to meet this test at much lower dollar levels typically than a match will. Okay, the next testing that we want to talk about is what's called the average benefits test. And once again, this test makes sure that the benefits cannot be overly skewed towards the highly compensated employees. Now, the average benefit test does consider all contributions to the plan. So the deferral in some instances is counted, employer match in some instances, and it converts it to that what's called the EBAR, equivalent benefit accrual rate. And that's, once again, where we look at how old the people are, how much they make, and we convert that to an estimated benefit when they reach the retirement age, typically 65 in the plan. And that drives the contribution that you can make so that everyone has not the same equivalent benefit accrual rate, but such that it's not overly skewed towards the highly compensated employees. In fact, it happens to be 70%. 70% is the threshold that everyone has to accrue at least 70% of the benefit of your highly compensated employees. The demographics of the company drive the results on this. There's no way around it. If you have an employee base that skews older, sometimes it's tough to skew the benefits towards you as the owner. But it's totally dependent on the demographics. If you're a small company, we've done this before. We'll say, hey, you know, if you would go out and hire, now you can't discriminate based on age. Obviously, that's an HR, violation. But if you had if you could go get a younger person and stick them in your company, sometimes it makes all the difference in the world. Just adding one person that's significantly younger than everyone else. Now, the last thing, I know one of the strategies we like to do, and Kevin Bassett, for those of you him, like to do, is use our children in the planning of our companies. Now, you do have to watch children as employees because your ownerships gets attributed to them. And so even if they're only making 10 grand a year, they're considered a highly compensated employee if they're related to the owner. And by the way, I think I missed that, but if you're an owner, doesn't matter what you make, you're considered a highly compensated employee, even if you're only paying yourself, $10,000 or whatever. So keep that in mind, that as an owner or a family member of the owner, you are considered a highly compensated employee. But when you take a child who's technically a highly compensated employee, but they're only making a little bit of money, sometimes it makes it hard to pass testing. The same thing with spouses. In the example that I'm going to show you is I set it up where the owner, and we have an owner spouse that's employed, as she's a corporate officer, so she gets a little bit of a salary to maximize this planning, but you do have to watch it when you're grouping people. And in that particular case, it did not work out having each person their own group, and I had to group the husband and wife into an owner class. But anyway, it can get confusing when you have family members because they're considered highly compensated employees whether they actually own anything or not, or no matter how much they make. Okay, so let's talk about some practical uses of the profit sharing plans. Number one, pair it with a 401k. There's no reason not to have a 401k if you're going to go through the trouble of a profit sharing plan. You can set it up and employees can defer their own money into it. And like I said, using the safe harbor 3% non-elected can really help you pass all those different tests that I have listed there. As I already said, it's harder to pass if you have a match where you're matching what the employee puts in. The also helps overcome the problem if not many employees are participating or deferring money into the plan. We used to see this a lot more before safe harbor plans were really prevalent, was people had problems meeting the deferral percentage testing, but this can help overcome it. On the other side, you can use this to reward specific groups of people besides the owners, especially if they're not a highly compensated employee. Let's say you have a really trusted and loyal, executive assistant that's been with you for 20 years or something like that, or you have a young superstar that you want to reward. It makes it really easy to target different groups and different individuals for additional reward. Now, I had a conversation the other day with somebody about this, and they were saying, well, gosh, we already have a bonus plan in place, and that is the case a lot of times. Just think about this though, with the profit sharing plan, if you use that as part of your bonus structure, it's much more tax advantage to you. I mean, right off the top, there's no payroll taxes, so the 7.65% employer, company portion is not there. There's no unemployment tax. It's not considered wages for workers' compensation premiums, et cetera, et cetera. So when you're looking at setting up a bonus plan, don't forget about the profit sharing. Now, employees, they like to get money in their pockets, spendable money. So you have that to weigh against the profit sharing plan. But from your perspective, it's a great way to bonus employees because it's very tax advantaged. Okay, so let's move on here to some examples here of some profit sharing plans themselves. Let me just drag this over here. If I could, from one of the moderators, can you see the Adobe PDF?
Yes.
Okay, super. Okay, so we have here a plan comparison, and what I've done is I took the same group of people and I ran, if you recall earlier in the slideshow, we talked about a pro rata, an integrated plan, and the permitted disparity integrated plan. Well, I ran the same group of people through all those plans, and I'm going to share with you the results of that. So we have here the traditional, which is same percentage to everybody. The integrated plan, which is integrated with Social Security, and then the age weighted. And you can see the census data of this, I'll show you in a minute. There's not much difference between these three, and that's because the owners don't make significantly more than everybody else. In fact, they're not even over the Social Security wage base, and they're not significantly older than everybody else, a little bit, but you can see there's not a lot of benefit between the three. And more significantly, this is showing the percentage of all the contributions that go to the owners of the company. So under a traditional plan, only 34%, under integrated, 34.6%, and then the age weighted, they get a little boost to 38%. But look at with my new comparability plan design, 76% of all the dollars going into the profit sharing plan now can go to the owners of the company. Once again, I don't, you can skew the benefits to whoever you want to. Typically, the owners are the ones that started out and made no money in the first couple of years and, struggled and mortgaged their house and, ate beans and rice and everything like that. So typically, they're a little bit late starting for retirement, and so we're skewing the benefits towards them. But just keep in mind, this example is skewed toward the owners, but you could do this with any group of people that you wanted to. So here's the census. You can see owner A, which is in fact the spouse, we pay just enough so that they can maximize their 401k. Owner B is under the wage base there at 104,000, and then a good mix of people. We have some people in their 20s. We have somebody that's 60. We have highly compensated employee that's not an owner. So a really good mix of different contribution amounts. Now you can see here the different. We'll focus here on the two owner lines. So under the traditional amount, here's what they would get in their accounts, 31 and 51. Under the integrated, 31 and 51. The age weighted, 32. And this person, owner B, is maxing out at 62. And then under the new comparability, you can see that the still maxing out at 62 here, and a little bit less on the spouse than the age weighted. You can see that went down from 33 to 32. But when you look down here, so this column here is the total cost. So to do a traditional profit sharing, the employer had to put in almost $242,000. The integrated, $239,000, and the age weighted, $247,000. And so you can see the benefit percentage to the principal. Under the new comparability, not only does 76% of the benefit go to the owners of the company, but the total dollars that they have to put in the plan drop precipitously to about $125,000. So this is a great sample here. In fact, let me make it a little bit bigger. This is a great sample to show the comparison between these. Most companies that have a profit sharing do the traditional. They just, 5% to everybody, 6% to everybody. If you're trying to target a specific group of people, that is suboptimal way to do it. Now, this is, I want to get to a couple. I'm not going to go through every one of the. I'm not going to go through every one of the scenarios. I'm going to skip right here to the new comparability plan. So you can see here 94,000 going to the contribution to the principals. 72% of their pay goes into the plan. So their earnings were 131. So 72% of what they earn gets to go into the plan, and 75% of the benefits accrue to them. Now, I wanted to, on one of the other slides that I'll show you, this is here what I wanted to show under the, look at this, owner A, 27,000 salary, over here, total contribution 33%, percent of pay, $122,000, 122% of their pay going into that on a percentage of pay basis. So it's actually possible under these plan designs to get more than the entire than what they make into the profit sharing plan. Okay, so I'm gonna go through here. I've got show you another the details of the new comparability plan here. So that one before was to show you the comparison of all the different ways you can do it. This delves into the details of the new comparability plan. So once again, same census data that we have for the plan. That's just some detail here. This is what I wanted to get to. So owner A earnings under the new comparability, they're putting in they're getting 120% of what they're paid put into the plan, $32,000. The owner B, total of $62,000 into the plan. This is, so we already talked about that 76% for the owners. Now here's where we factor in the tax aspect to the plan. So what this shows you is at different tax brackets, what is the net cost of the plan? So the lowest tax bracket right now is 12%, federal 37%. Now obviously I know, we got a lot of Maui people in California and other high tax states. Just think at the state, if you factor in the state, these benefits are going to be even better than this. But even at the federal level, so the employer contribution to this plan, so the total contributions, as you recall, are here, including the deferrals into the plan. So if you take out the deferrals, the company has to fork over an extra $74,000 a year. The tax savings on that at the 37% bracket are $27,000. And so the net cost, if you factor in the tax, is $46,946. But the principals are getting $44,571 of that, or 95%. So the net cost of the plan, meaning the amount of money that actually comes out of the owner's of the company's pocket, is $2,375 on an after-tax basis, is all that it costs for the owners to put away total contributions of $94,000 into their plans. So hopefully that makes sense. If not, please ask me some questions. Now this number here, a lot of times the net cost of the plan, we can drive negative, especially on cash balance plans, which we're going to talk about in our next meeting. And I didn't play around with this for too long. I mean, that's a minimal enough cost it's a really good plan design. It's very advantageous for the owners. You can see here, so here's some of our testing. The ADP test, it actually fails. Now, because it's a safe harbor, it doesn't matter that it failed. This one had the 3% non-elective. So even though it would ordinarily fail, what this is saying is that the highly compensated employees, which are 3, their deferral percentage averages 33% of their pay. The non-highly compensated employees, their deferral percentage only is 7%. The maximum for the highly compensated could only be 9%, so it fails that. But by giving everybody that 3%, you automatically pass. The rest of it talks about the, remember I told you the ratio percentage must be at least 70%. The average E-bar for non-highly compensated versus highly compensated. So you can see the E-bar for highly compensated is more than non-highly compensated, but it can't be more than 70%. So we pass that testing, and it passes all the testing. Okay, so we should be back to the main slideshow, I believe.
Looks like it.
Yep.
Okay, so just to kind of wrap up here, we'll get to questions in just a second. Next time, we're going to be talking about defined benefit pension plans, as well as the cash balance plan, which is in fact a defined benefit plan, but it's kind of a hybrid plan. It's one of my favorite plans for those of you out there that, your business is really cranking at level 2 or you're at level 3 and you have really fairly high, steady excess cash flow. The cash balance plan is a way to put away hundreds of thousands of dollars into your own accounts. You saw in the cross-tested plan, a husband and wife owner, we were able to put away almost 100,000 into the plan. The cash balance plan, that number goes up by multiples. So we'll talk about that next time. But yeah, so we're ready for some questions. Jen, if we have any.
If anybody has a question, you can add it to the Q&A pane, or if you want to raise your hand and ask it, we can unmute your audio on this side for that.
I have one from someone here. It says, we have cross-tested new comp 401k, 2 owners, 15 employees. We have discovered that one of the owners has huge Roth IRA balances and stopped contributing to a 401k. The other owner still contributes. Will this screw up the end of the year profit sharing tests where we are hoping to max out the contributions to both owners at $60,000?
No, if they're a owner, if they're not participating in the plan, then that's fine. You could actually put them in their own group, and not giving a lot of money to a highly compensated person or owner actually helps you pass testing.
Okay.
Yeah.
Next, we have, well, it's in addition to that, I don't know if this matters in addition, but it says salaries are 140K for each owner, and one owner will put away 24K and the other 0.
Yeah, same concept. You can always discriminate in your plan against the highly compensated employees, and so that shouldn't be a problem. If one owner is not participating, it will actually help you pass testing, and the one that is participating will allow them to get more. Now, there's still, you can actually, in the example I showed, I had the owners also getting the 3% non-elective contribution. You can actually exclude owners and highly compensated employees from the 3% non-elective match. Sometimes we'll do that to get it past testing. In this particular example, it passed with them getting the 3%, so I left it in there. But sometimes, so for example, the one you're getting and you have an owner that's not contributing, you may not even have to give him the 3% non-elective, depending on what percentage of the company he owns and if you can get away with that.
Now, if the owner wants profit sharing, will that change anything?
Sure, yeah.
Okay.
I mean, the testing, he still has to pass the testing, and if he wants to be included in the profit sharing, you can do that. The fact that he's not deferring anything, like I said, it actually is going to help to some extent the testing.
Okay, great. We have a next one here. It says, David, as the number of employees increase, does the benefit to owners improve or get worse?
As the number of employees increases?
Yep. Does the benefit to owners improve or get worse?
Yeah, I mean, it depends on the demographics of your company. I mean, at some point, if you have 1,000 employees and you got to give them all 3%, well, of course, you're not going to be able to put enough money away in your own. If you say you're the sole owner, I mean, you're limited to $62,000 in your account. So at some point, and I just did the math real quick. So if your payroll is above $2 million and you have to give everybody at least 3%, well, you're going to have to give everybody at least 62,000 for you to get 62,000 as well. So there is a point at which it can be. At that point, that's where the cash balance plan sometimes comes into play, or you also maybe just look at it as a benefit of something that you want to offer to attract employees.
Okay. We have another question that asks if you could talk about vesting. Can it be set with the profit sharing? How can you have the vesting and the profit sharing set?
Oh, yes, of course. So we didn't talk about that much. So vesting, you're allowed to customize the employer contributions when they're vested. So vesting means when you put money in an employee's account, at what point is it actually theirs to do with what they wish? So, for example, you may have a 3-year vest, meaning you give them a 3%, but it only becomes theirs 1% a year for 3%. Now that does go into the testing of the plan, but you are allowed to set restricted vesting schedules. Unlike a safe harbor, on the safe harbor side of the 401k, one of the things that makes it a safe harbor plan is immediate vesting. On the profit sharing plan, there is no requirement that it be immediate vesting.
Okay. That looks to be the last of our questions for now. Okay, let's see. Looks like we're all set on this end.
Okay. Give it sort of one last chance. Maybe wants to
One
raise.
last chance. Anybody else would like to have their hand raised or add a question? And also, if you do, if you want to switch to the next page too, there is also the information as far as.
I think I just saw a question come in.
You see a question come in here? Let's see.
For higher cost of living states, can you talk about the other alternative for defining highly compensated employees?
Oh, good.
Yeah, I mean for the highly compensated testing, you know, the level, the basic level is set by the statute, and the way that we get around that is by setting up, when you set each person up into a group, into their own group, we can get around that fact by allocating more to them if we need to, because sometimes by default, especially when you design the plans, if all the highly compensated employees get lumped in together, you may lump in a non-owner highly compensated employee into that mix, and you don't want to really, sort of punish them. Like I said, if by not doing a 3% non-elective or something like that. So we usually try to work around that with the actual design of the plan.
Okay, great. Give a few more seconds to see if anyone else wants to chime in for a question. And if you do have any other further questions, you can always email. The contact information is info@blueskywa.com, and we'll be happy to pass them on to David and have him answer them for you. And we will have 2 more of these webinars coming up, I believe.
Right. Like I said, the next one will focus on defined benefit plans, which have really gone out of favor, but for small companies, they can be a real benefit. Or even better is the cash balance plan, which is a lot easier to administer, but it's some really good things. If you've got high cash flow, high earnings, and you're looking to sock away hundreds of thousands of dollars, it's a really great option. So we'll look forward to seeing everybody. I think it's actually in April, after got to get through the tax season here.
Right.
But I think it's in April, shortly after the tax deadline.
Yes.
Yeah.
It's going to be actually, we have May 9th, and then we have another one. Yeah. Okay. Let's see.
Okay, well, that's all right. We'll get, obviously, the reminders come out through.
That's right.
Yeah. Okay, well, thanks for coming, everybody. I enjoyed it, and I hope you did.
Thanks, David.